Hi there, welcome to The Open right here on BNN Bloomberg. Of course, we're going to be all over the turmoil in the oil market. We did see crude moving higher yet again today amid fears of a virtual shutdown of traffic through the Strait of Hormuz in the Middle East. We also got those Broadcom earnings, an important bellwether for AI demand. Let's get to the other big stories we are bringing you from the BNN Bloomberg newsroom. Canadian Natural Resources posted revenue that topped estimates, and it also reported better than expected fourth quarter profit. There was record production that helped offset weaker oil prices. The country's biggest oil and gas producer increased production nearly 13% year over year and also raised its output forecast for this year. Of course, there still are fears hanging over the market that the global market is oversupplied in the medium term. Maple Leaf Foods also reported its full-year results, with sales up 8% in the quarter and profits sharply higher from a year ago. The company said it expects continued revenue growth and further margin improvement this year, as it experiences strong demand for so-called protein products. Linamar posted its fourth quarter profit, and it came in at $110 million. That was a turnaround from a loss in the same period a year ago. The auto parts maker also posted higher sales, and it said most of its products shipped to the U.S. remained tariff-free under the Canada-U.S.-Mexico trade agreement. And let's check in on shares of some of those companies over the past year. Look at that. Canadian Natural Resources up more than 55%, excluding its relatively generous dividend. Look at that, in a 12-month return. Trading near or at record highs. And let's have a look at Linamar. And we're going to be talking later on the show to Linda Hassenfratz, executive chair of the board. We're expecting to connect with her very shortly, in about 20 minutes' time. Now let's see how Maple Leaf Foods has been doing lately. That stock has been struggling a bit. You can see it is, though, up 6% in the past year. And now let's have a look at how U.S. futures are trading today. Looks like we are going to get a slightly lower open for American equities today. Broadcom shares moved up in the pre-market. That company, known for chips, posted a revenue beat and a positive outlook on revenue. The CEO says he sees AI device sales topping $100 billion US in 2027. We're joined by Atif Malik, analyst at Citi. Thanks very much indeed for joining us. What jumped out for you with the Broadcom numbers?
Yes, Broadcom, a leader in custom AI semiconductor chips, stock up 4 or 5%. We'll see if those gains hold, as NVIDIA, their other mega cap semiconductor peer, had strong results as well, but was unable to hold the gains. The biggest debate around these two AI semiconductor names is around the sustainability of the hyperscalers' free cash flow and capex spending, because that's what's drive the AI infrastructure spending. And Broadcom navigated that narrative a lot better than NVIDIA. They provided fiscal 27, which is next year's outlook of 100 billion plus sales, like you pointed out, and that gives investors confidence that the spending will continue into next year.
The company, it used to be known apparently for radio frequency chips that it sold to Apple, but it has managed this massive transition to the AI device market.
Absolutely, you're correct. They're still a supplier for the radio frequency chips to Apple, but that's become more than less than 10% of their sales. What happened for them is their partnership with Google that has been working on custom AI semiconductor chips known as TPU, tensor processor units, for the last 10 years. And as Google's business takes off with Gemini and search and everything, they're benefiting from that partnership they've had, and Google remains their biggest customer, more than 40% of their AI sales.
Yeah, the Wall Street Journal says that has been a concern among investors, that exposure to Google.
Correct. And they addressed that quite adequately on the earnings call by saying that their sales to Google will accelerate into 27 as Google moves on to their 11th generation chip. They're saying that there could be multiple chips for Gemini workloads, and they remain the default for Gemini.
The journal also says that software is still an important part of Broadcom's business. It's about 40% of the revenue. But the software sales or revenue from software were up only 1% year over year. Is that a weakness for Broadcom?
Not in this market where everyone is worried about software stocks and software getting somehow hit by agentic AI and all the innovation that's happening in AI. I mean, yes, you're correct. It is around 40% of the sales, but it's going to go down to 20% of the sales over the next 2 years. And their response to the risk or the threat of agentic AI kind of cannibalizing some of their software sales was also a good one, where they said that VMware, which is the company that they acquired a couple of years ago, is a mission critical and non-displaceable infrastructure layer, which connects the hardware, the networking, the storage to the firmware, and it is going to benefit from agentic AI workloads and not being at risk from it. So in this environment where people and software stocks have been worried about software exposure, less is more.
Maybe we could look at a 5-year chart for the stock, because going into this, we had seen some weakness in the shares.
That's correct. I mean, it was an outperformer last year, and it has been growing. Remember, NVIDIA is the dominant 80% of the compute AI chips. They make what's called GPUs, general processor units. So these are the compute chips that you and I can pick off the shelf and put it in our AI data centers and run our AI workloads. What Broadcom does is very different. They make custom chips. So if you are Google or Anthropic, you will come to Broadcom and say, look, we have a very high volume workload that we want to customize. And it takes about 3-year process to make that chip with Broadcom. They have tremendous IP around connectivity, around storage, around compute. So it is a different, their chip is a different beast. It's a 20% of the compute market, but NVIDIA is still the leader. The stock has been up and down because of the lumpiness in their. They only have 6 customers versus NVIDIA having more than 50 customers. So with the customers, the quarter-to-quarter volatility could be an issue for the stock versus general purpose GPUs, which are more linear.
I'm sorry, can you remind me, what is your rating and price target on Broadcom right now, Chief?
Yeah, we raised it to $475, which is a 30 multiple, PE multiple on $16 type of earnings next year.
We'd better leave it there. Thank you very much, Atif. Really appreciate it.
Thank you.
Atif Malik, analyst at Citi. After the break, we are going to look at pushback against that massive multi-billion-dollar high-speed rail plan for trains that would run between Toronto and Montreal. That's ahead. Some Eastern Ontario residents are speaking out against the proposed high-speed rail line by Alto that would see travel times significantly cut between Toronto and Montreal. Let's get more from CTV's Camille Karamali. Thanks very much for joining us, Camille. So it's a mega project, $60 to $90 billion at this stage, probably going to go up. What is the main concern being expressed by these residents?
Yeah, it's made primarily of 5 municipalities in eastern Ontario, primarily made up of farmers, small town residents, and city councillors as well, drawing concern of how this rail line would cut through a lot of their land and also focusing on, especially the farmers, on what this would mean for the wildlife, what is to them the precious farmland where they grow crops as well. So we're hearing quite a bit from this coalition, the Ontario Federation of Agriculture, and a similar body in Quebec also highlighting these similar concerns, calling for the suspension of the project. They say once their fields are cut down the middle, they won't have a choice but to sell their land to the federal government. But even when those fields are cut and sliced down by this rail line, they're saying that it would block country roads and cause longer routes and bottleneck for drivers. It would be a major inconvenience for a lot of those residents there. So we're hearing a bit about from them on how they're pushing back as of now against this rail line that would be, if all goes according to plan, up and running by the earliest 2029.
And give us a little bit more on the plans for this line. Quite a boost for Peterborough, obviously. It's going to run there as opposed to along the shores of Lake Ontario.
Yeah, exactly. We're talking about Quebec City, Trois-Rivières, Laval, Ottawa, Peterborough, and Toronto. This is the municipalities that the federal government wants this line to run through, and it would really cut down a lot of transportation time especially the first phase, about 100 kilometers going through the stretch of eastern Ontario. But primarily, it would begin with a line between Ottawa and Montreal. And so what we know is that right now there are 2 proposed routes that this could take, and for many of those eastern Ontario residents, we're hearing that once again, just to summarize what their concerns are, this line cutting through their land, seeing no benefits on their end is what they're saying, and would cost them billions of dollars, especially when it comes to wildlife, their farmland, and the inconvenience it would have in terms of cutting through country roads as well, deterring traffic and deviating it as well. So they're just saying that they're not seeing any benefits when or if this line cuts through their land.
Thanks very much, Camille.
Anytime.
Let's stick with travel infrastructure. The operator of the Port of Churchill has signed an agreement with the Port of Antwerp-Bruges, one of the world's shipping hubs. CTV's Alex Carpa has more on what this could mean economically for Canada.
This is the Port of Churchill. It's situated on the shores of Hudson Bay in northern Manitoba and is the only deepwater seaport in northern Canada. Interest in revitalizing the port has grown in recent years as Canada seeks to diversify its global trade. Leading this effort is the port's operator Arctic Gateway Group, which has secured a major trade agreement with a prominent European port.
This is a great partnership and a great relationship.
The agreement with Belgium's Port of Antwerp will focus on developing transport of materials, including critical minerals and energy products, between Canada and the EU.
We think there's a huge opportunity for us to establish more trade between Western Canada and abroad through this agreement.
An economist says Europe is looking for reliable markets around the world, and Canada presents a good option for them.
So this is very much a win-win. A win for Canadians, particularly those in the north, getting access to better markets and more jobs, and a win for Europeans because now they can get access to Canadian goods without having to worry about geopolitical issues.
Last month, Ottawa says it's considering a major expansion of the Port of Churchill that would transform the northern Manitoba facility into a year-round multi-commodity trade hub. Some living in Churchill are encouraged about the renewed interest in the port, but hope these agreements and words turn into action.
We've seen lots of documents signed and MOUs and things like that, so those are all good, of course, but the next step obviously is putting action to these agreements.
Avery says revitalizing the port has a lot of benefits.
To reestablish ourselves as an energy superpower, to assert our sovereignty in the north, and also to advance Indigenous economic reconciliation.
With Avery going on to say the port may soon play a much bigger role in Canada's economic strategy. Alex Carpa, CTV News, Winnipeg.
Coming up, excuse me, we're going to hear from Linda Hassan-Fratz of Linamar. Raymond James says the company posted yet another series of strong results. Linamar just announced its numbers. Raymond James has a hold on the stock, but says the company has produced a series of decent earnings reports. Let's get more from Linda Hassan-Fratz, Executive Chair of the Board at Linamar. Thanks very much indeed for joining us.
It's a pleasure.
Despite all the turmoil in the auto market, your auto parts business or mobility, you had double-digit growth on both sales and underlying earnings in the latest quarter.
Yes, actually, and for the year as well, we had really strong earnings growth for the mobility segment, which has a lot of launches going on that are all helping to grow our top line and our bottom line. So we're really happy with where things are going on the auto side, because after all, auto parts are quite different from autos. So whereas the vehicles have tariffs, auto parts, as long as you're USMCA compliant, have no tariffs.
And so you've not been affected directly very much by Trump's tariffs at this stage?
That's correct. Certainly not in the auto business. In the auto business, because everything we do that we ship to the U.S., we make within North America. So that's been a long-time strategy of Linamar, to not make parts in Asia or Europe and ship them to North America. We try and stay within the same continent that our customer is. So we make parts in Europe for Europe, Asia for Asia, and North America for North America. So that means if you're USMCA compliant, anything shipping from Canada or Mexico into the US is tariff-free. So our industrial business has some impact. It's not zero, but it's a manageable level, and we're working to mitigate those costs further.
Just remind us of your auto parts / mobility business, revenue-wise. How much is in Europe, how much is in Asia, and how much is in North America?
Yeah, by far the largest percentage is in North America. I mean, if I look at, we have 86 plants around the world, 75 of them are in the mobility business. And of that, 22 are in Europe and just 6 in Asia. So obviously the lion's share of our mobility facilities are right here in North America.
And then you have your industrial business. We know it for Skyjack and those scissors. I think they're another type of lift. And then, of course, agricultural equipment. Can you give us a rough breakdown between your auto parts and your industrial? Which is the biggest revenue and profit supplier?
Yeah, so from a revenue perspective, the mobility business, which is auto parts, but also other types of vehicle on highway and off highway. So it is a blend there. It's not just sort of pass car, but that does represent 75% of our sales at the moment. So the other 25% is split between our Skyjack business, where we make scissor lifts, boom lifts, and telehandlers, and our agricultural business, where we make a whole series of different types of products for the crop cycle, from tillage to fertilization to seeding to harvest and post-harvest. So quite a big and growing business in the ag side.
What about the environment right there? I mean, farmers have been beset by low prices lately. Apparently a big swing will be, or a big determinant of their profits will be, when America gets around to announcing its level of price supports and incentives for the farm sector.
Yeah, the ag business is certainly in a down cycle. It has been for the last couple of years. So typically we're down in the egg markets, then you're kind of down more the next year, and then it starts to improve a little. So we are seeing this year, or expecting this year, to see that, little bit of improvement. When I say improvement, I mean it's not declining as much as it did last year. So the rate of decline is moderating. And we do see that happening through this year even. So starting out the year at a more negative place, and then by the end of the year, we're expecting the market to start moderating in terms of that decline. So that's a positive for the egg business. And in access, the market is predicted to be reasonably flat this year after a big down year in the market last year. Now, the good news is we've been growing market share in our agricultural business and in our access business, and that really helps to go a long way to offset these softer markets.
Just looking at your 5-year stock return here, total return of about 40%, including dividend. Bloomberg is showing a gain in the stock of about 30%. Our chart is showing 25%, but so not too far out. You certainly have outpaced Magna over the past 5 years.
Yeah, I mean, I think that when I look at our longer-term performance, Linamar has a great track record of consistent, sustainable performance. So it really drives out of this diversified model that we've created. We have our auto business, pass car, we've got commercial vehicle, we've got off-highway, we've got the ag, we've got access. And, they don't all sort of work on exactly the same cycles. So as a result, when things are a little soft on the auto side, often things are going well on the ag business, and vice versa. So, as I just mentioned, things were a little soft on the industrial side last year, but at the same time, great growth on the auto side. So, in fact, if I look back over the last 16 years, we have grown our top line and our bottom line 81% of those years. 81% of the last 16 years, we've seen top and bottom line growth. And in the majority of those years, it was double-digit growth. Every year that we grew, but I think 2 or 3, we grew in double digits. So that consistent, sustainable growth, I think, is the basis for share price appreciation. I mean, we're delivering year after year after year, continuing to build market share, winning new business. We had a great year for new business wins last year. Our Canadian plants, as an example, had an outstanding year. They won more new business in our mobility business and our auto business than we have in the last 3 years. We won last year in 2025. So we're pretty proud of that.
Sorry, Linda. Thank you very much. We're going to have to leave it there. Linda Hassan-Fratse, Executive Chair of the Board at Linamar. Opening bells are next. Let's get going on this Thursday. Trading has started at the NASDAQ, the UN Global Compact Network USA, and Women in NASDAQ ringing the opening bell. At the New York Stock Exchange, Pentair is doing the honors. And at the TSX, Outcrop Silver and Gold, working on a project in Colombia, is celebrating its graduation to the TSX. It's time for the first 15. Let's check in on the North American benchmarks to see how they're faring today. And we are seeing slippage in early trading amid fears of possible global inflation because of the shutdown in shipments of energy through the Gulf of Hormuz. That's a particular concern in Asia. So you can see the TSX down about 1% in early trading. On Monday, it ended at a record high, 34,541, but losing altitude right now. And there are the U.S. stocks. They're down slightly less Interesting, though, apparently jobless claims staying low in the United States, and Bloomberg says that's a sign of a steadying labor market. But oil, of course, has been, that surging oil price has been a weight on investor sentiment because it does increase. The cost of living increases the cost base for companies. And oil this morning, wow, topping $78 in New York, so not far short of $80 US oil right now. Let's check out some stocks of interest. C&Q, speaking of oil, announcing its numbers, and that stock jumping, of course, helped by the higher oil price this morning. I'm pretty sure that's going to be a record high for Canadian Natural. Core of that company's business is its giant oil sands operations. Investors love the fact that they don't have to keep finding new oil. They know it's there and they know that it's going to last for decades. And sure enough, C&Q certainly trading in record territory right now. Yeah, pretty sure. Yep, blasting to a new record high, according to my screen. Let's have a look at Linamar. We just spoke to Linda Hasselfratz, and that company posting another quarter that met or exceeded expectations. Raymond James admitting, we were a bit too pessimistic with the company, and hiking its target price on Linamar. And finally, Maple Leaf Foods, the big supplier of bacon, and or certainly active in the meat. They have spun off their Canada Packers operation, and they came out with profit of almost $400 million, boosted by the spin-off of the pork business. Let's get down to Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. He's got his eye on some U.S. stocks on the move. Jeff, thanks for joining us.
My pleasure. Thanks for having me.
Start with Broadcom, if you would, please.
You bet. Yeah, the big one this morning is Broadcom. So this is one of the top stocks in terms of weight on the S&P 500, and it's one of the top stocks in terms of moving the index this morning. It is one of the top performing stocks, up about 6% in the pre-market session. Definitely going to be one to watch over the course of the trading session. Not only were first quarter results better than expectations, the company also came out and said that its second quarter results it expected to earn about $22 billion in the second quarter. Analysts only expected it to earn $20.5 billion. This earned it a couple price target hikes at Baird, at Evercore, and at Truist Securities this morning. So the stock is moving sharply higher. This had been one that had been closely watched because, of course, AI spending and spending on chips has been in sharp focus as investors have been trying to kind of parse out what the next leg is going to be in the AI trade. This company putting some of those fears to rest this morning. The CEO of Broadcom said that he expects to sell $100 billion worth of his own AI chips in the calendar year 2027. So a great big boost for Broadcom this morning. Even if the U.S. stock index is falling, this is a big boost because it is such a big weight on the S&P 500.
Yeah, it's amazing how Broadcom were smart enough to pivot into the AI chip business. Trade Desk, remind us what they do, what's going on with the shares.
Yeah, Trade Desk is a media advertising company. And this is a company that we've been talking about in recent weeks, partly because it sold off so sharply after its own quarterly results. The company's results just last week were so bad that investors and analysts on Wall Street had said that even before the impact of AI shows up, we are seeing weakness here. Well, if investors were concerned about the impact of AI weighing on this business and the potentially AI coming to eat the business, what they've come out and done this morning is they have apparently been in talks to partner with OpenAI to sell ads for OpenAI. This is according to a report in The Information. They are going to be selling advertising potentially selling advertising for OpenAI, and the stock is getting a tremendous boost as a result. This is the top performer in the S&P 500 so far. Wow, 25% is even better than it was in the pre-market session. And really erases some of those losses from last week.
We'd better jump. Jeff, thank you very much indeed. That's Jeff Morgan of Bloomberg. Coming up, some ideas on how to protect your investments as the fighting in the Middle East, the U.S. and Israeli attacks on Iran, enter their 6th day. Our guest suggests with stock markets weak, a broad commodity exposure is a good hedge against inflationary impacts of this crisis. We're joined by Chad All, Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Asset Management. Chad, thanks very much for joining us. Oil going up, $78 US in North American trading today, and that does point to inflation.
Yeah, certainly, and I mean this is another example with geopolitical risk, particularly in the Middle East. At the end of the day, it's primarily the concern for the market is that energy shock and the energy inflation. Really points to the fact that fixed income, for example, with rates being highly sensitive to that inflation story as well. The best hedge from a portfolio construction perspective is some broad commodity exposure. And even tactically, it's been very beneficial to our portfolios to be, again, overweight energy commodities coming into this event. And gold, which has been, it hasn't responded perhaps quite as much of a safe haven. We do think that it will, the longer this crisis may prolong, I think gold will become a pretty good hedge again. There was just, pretty frothy action in gold markets in the last, number of months now that there had to be a little bit of steam to come off. But I do think precious metals will ultimately be a good hedge as well.
Yeah, I guess the one thing is if the US dollar does strengthen because people go to it because it's a big liquid currency, that will tend to hold gold back.
Yeah, and we've had a theme as well, kind of the setup coming into here, at least the last, roughly 18 months now, almost, year and a half, where you have had US dollar strengthening, along with that, a rotation away from US equities to more international markets, Europe and Asia. And I think this setup here, so with those safe haven flows back towards the US, I think you're going to see some US dollar strength. Given also positioning was skewed towards being more underweight the US dollar. So I think you're going to see some movement back towards the US dollar. And then even on your equity positioning, we do think this is going to take a little bit of a rotation back towards US equities. Even those inflationary impacts that we mentioned earlier on, ultimately Europe and Asia are far more exposed to disruptions to energy flow from the Middle East and particularly beyond oil, liquefied natural gas, significant price hikes that we've seen in the natural gas space really affecting Europe and Asia to a far greater degree. So I think, given that recent outperformance for international markets, I think you're going to see a little bit of a bid back towards U.S. markets and the U.S. dollar at the same time.
Yeah, Asia, I saw that the South Korean market has bounced back a bit, a gain of about 10%, but it's been in a frightening slide this week.
Certainly after some significant gains as well. And I mean, the construction of that market, obviously, significantly skewed to a couple of names, Samsung as well, for instance. So, a lot of what we saw this week and certainly earlier this week was also just kind of a deleveraging trade. This kind of, recent winners across assets took a lot of the brunt of the selling. So you could tell that there was some forced selling, some forced de-risking. So as the froth comes off some of those markets, you are going to see, I think, the underlying strength of certain characteristics. Precious metals, I think, is the one that got kind of caught up in that deleveraging that I do think gold prices, for example, gold will be a better hedge for a more prolonged conflict. So again, gets back into having that more diversified exposure and commodities, energy, precious metals in particular, quite beneficial to staying diversified in your portfolio, making some tweaks to overall positioning certainly can make sense when it comes to geopolitical risk. But at the same time, significant deleveraging has typically not been the right thing to do. So significantly de-risking your portfolio, as geopolitics is typically the type of risk that markets, that kind of wall of worry that they tend to climb, that's generally where geopolitics lie.
Sorry, give us that point again. The markets.
So we always talk about, that, markets climb a wall of worry, right? So there's certain risks, and generally the geopolitical risks are ones that, cause some short-term concerns for markets, but they typically begin to climb that wall of worry as, worst-case scenarios don't typically play out when it comes to geopolitics. So that's why it's rarely a good choice for investors to significantly de-risk their portfolios, but more do kind of a sanity check and make sure they've got some broad diversifiers, things like commodities in the portfolio that can help to weather the storm.
What about defense stocks? I mean, I know it's a cliche at this stage. People are going to be spending more on defense, unfortunately, wasting money on that instead of building schools, etc., and museums. In any case, without commenting on individual stocks, people are watching names like Stantec and Aecon. They are in line for a big radar win in Canada, for example.
Yeah, and this I would call them as the theme around defense stocks, and we certainly saw this in Europe-based defense stocks last year. This was already a theme that was playing out quite strongly. Some very strong outperformance in European defense stocks. That speaks more to the general theme going on around a world moving from kind of a single polar North American-driven consensus to one that's more multipolar in nature, where more and more countries are beginning to increase their defense budgets, beginning to take more responsibility, let's say, towards their own defense, their own infrastructure build. We see it here in Canada as well. So that's an ongoing theme. I think conflict certainly does raise, pull forward some of the pricing in terms of market reaction to that theme. But I do think that's an ongoing theme that's something that's likely to play out now over a period of years.
Yeah, and it's going to be tricky because we know you're subject to the vagaries and whims of government when it comes to actual defense awards. Chad, thank you very much indeed. Really appreciate it.
Great to be here. Thank you.
Chad Ohl, Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Management. Yesterday on Market Call, we were joined by John Zechner, Chairman and Founder of J. Zechner Associates, covering North American large caps. His top picks were Constellation Software. He does see a turnaround there, presumably North American construction and Microsoft. And today on the show, it's Ryan Modesto, CEO and Portfolio Manager at I2I Capital, and he'll be taking your questions on North American stocks. Just ahead, we are going to put the spotlight on the electric vehicle industry. Windsor's Nexstar battery plant is pushing ahead with business as usual, despite an EV slowdown. Canada's first commercial-scale EV battery factory is celebrating its grand opening today. Let's get more from CTV's Jeremy Sharon. Jeremy, thanks very much. Ministers love to be around when there's a ribbon to be cut. Industry Minister Melanie Joly will be turning up in Windsor later for the grand opening of this factory.
Yeah, exactly, Andy. Look, this is the Nexstar Energy battery manufacturing plant. It is a massive facility. We're talking about 4.23 million square feet. And the company says already it has invested 5 billion Canadian in the economy through this project and added direct 1,300 jobs. It's expected to continue to scale up eventually to reach 2,500 jobs. This was a joint venture between Stellantis and LG Energy Solutions in terms of ownership of this battery manufacturing plant. Stellantis has recently, just in the early months of this year, chosen to go off in a different direction. And so this is solely owned now by LG Energy Solutions. But we're talking about a plant that is producing lithium-ion batteries suitable for both EVs and for energy storage systems. That's where LG, of course, comes into play. Stellantis will remain a customer and will purchase some of these batteries, but is no longer an owner of this facility. But this is significant in Canada's establishing of an ecosystem around not only EVs but battery manufacturing, and an impact it could have down the line on EV manufacturing in the country as the federal government kind of changes course on its approach to incentivizing companies to manufacture more EVs. We've seen a bit of a fracture in the North American auto sector. The U.S. has been clear it is prioritizing its own interests. We're no longer looking at kind of this North American auto sector. Rather, we're seeing companies really prioritize themselves in the U.S. Stellantis, for example, shutting down its Brampton plant and moving the production of the Jeep Compass to the U.S. As a result, Canada is looking to adjust, right, Andy? And so I think this is, this company is saying that this will be a crucial piece to the ecosystem down the line as Canada looks to, shift to prioritizing production and manufacturing of more EVs here in Canada.
Certainly, there's been so many blows for automaking in Ontario. This EV battery plant looks like a ray of sunshine at this stage.
Sorry, I missed the last part there, Andy.
Sorry, this EV battery plant is a bit of good news after so many losses. Yeah, sorry, go on.
Yeah, absolutely. No, to your point, that we just talked about Stellantis' Brampton plant moving. And so this is certainly a welcome news. And I think for the industry, and I think when you look at what the Canadian government has announced in the last little bit in terms of investing in just last month, millions of dollars in new EV chargers across the country, 8,000 new chargers across the country, and the deal that they've recently signed with China to bring in more Chinese EVs, but also pushing for joint ventures between Chinese manufacturers and Canadian companies to establish supply chains here in Canada. A plant like this that is manufacturing the batteries could be crucial, again, to that ecosystem down the line.
Thanks very much. Really appreciate it, Jeremy. Jeremy Sharon. Up next, we're going to look at some of the stocks moving in early trading. And we'll check out how gas prices across the country have been going up as a result of this Iran conflict. The US and Israeli attacks on Iran have pushed the price of oil higher, and gasoline prices have been rising across Canada. CTV's Heather Wright filed this report.
Sticker shock at the pump with prices soaring across the country overnight.
I expect inflation at 3.5% by the end of the year.
According to GasBuddy.com, drivers in BC and PEI are paying the most, an average of 161.9 cents a litre in BC and 154.2 cents a litre in PEI. Quebec is seeing prices around 152 per litre, Ontario averaging 136.6 a litre, while the lowest prices are in Manitoba, Saskatchewan, and Alberta.
The longer this conflict goes, the greater the likelihood the price will reach levels that are extraordinarily uncomfortable for most Canadians.
20% of all oil traded passes through the Strait of Hormuz in the Persian Gulf, which Iran controls. Tanker traffic has been disrupted while energy facilities throughout the region have been attacked. While gas prices across the West are rising, China is feeling the pain much more acutely as they import 70% of their energy from the Persian Gulf. And some believe the U.S.-led strikes in Iran may also be a way to target Beijing ahead of President Trump's visit there later this month.
The fact that gas prices for me are a little bit higher while my competitor simply doesn't have gas is maybe another consideration.
Despite being an energy-rich nation, experts say Canadians are unlikely to see any relief at the pumps as efforts to scale up oil and gas production cannot be done overnight. It's something that doesn't sit well with Luka Mihalik.
They should have done something 10 years ago, not today. Today, what can you do? There are concerns the conflict in the Middle East will have an impact similar to Russia's full-scale invasion of Ukraine 4 years ago, when the price of a barrel of oil jumped by 20%. There is more oil at play in this conflict, but analysts say it all depends on how long the war lasts. Heather Wright, CTV News, Toronto.
Let's have a look at the markets. We'll start off with North America's big bourses. You can see there is selling today in Toronto and on the S&P 500, although NASDAQ now holding its own. Broadcom has been a help there. Investors happy with the results from that company. Of course, it's a major player in AI chips and other devices, and that stock jumping about 6%. NVIDIA is pretty flat. But let's have a look, though, at some other movers. Speaking of tech, Trade Desk, we touched on this with Jeff Morgan earlier. Company is involved in helping advertisers over the internet, the information reporting that it has been in talks with OpenAI, the AI giant, to sell ads. There have been worries, though, about Trade Desk's basic franchise, though, and if AI will draw ad spending away from the regular internet. They have massive partners in traditional or so-called traditional online media, including Walmart. So this is seen as something of a relief, but the stock is bouncing from a low level there. Victoria's Secret doing well, up 12%. This is the best year it's forecasting since it split off from L Brands. The company has been reviving the business, partly with its pink business, which caters to younger consumers. It's trying to get away from its reliance. Victoria's Secret now down. And that's interesting because initially I thought the reaction was positive to that. Victoria's Secret down. Investors still not buying into that. And the stock, though, has gone up over the longer term under the current CEO. Okay, we got lots more ahead. Okay, let's get into the second hour of the Open. We've so much to talk about, especially the surge in oil prices. First, though, the big stories we're bringing you from our newsroom. Home sales in the Greater Toronto area have been under pressure again. Both buyers and sellers remaining on the sidelines. Toronto Regional Real Estate Board says more than 3,000 homes were sold during the month, but that was down more than 6% from a year ago. And the average selling price also fell 7% to just over $1 million. The board says if listings continue to tighten this spring, competition among buyers could pick up. That's what the industry would like to see. And of course, they hope that that'll push prices higher later in the year. Shares in Maple Leaf Foods up about 5%. That big supplier of meat reported higher fourth quarter profit that topped estimates. The quarter saw the spin-off of the company's pork business as publicly traded Canada Packers. It also saw decent sales in prepared foods and poultry. Maple Leaf says it expects continued revenue growth and more profit margin improvement in 2026. And Linamar shares up about 2%. They've been a double in the past year. The company reported fourth quarter profit of $110 million after posting a loss in the same period a year ago. And we just heard from the executive chairperson, Linda Hasselfratz. The auto parts maker reported higher sales and says that most of its products shipped to the U.S. remain tariff-free under the Canada-U.S.-Mexico trade agreement. And there's a look at the TSX slipping a little bit in trading today. Let's check in on the U.S. markets. The NASDAQ has been holding its own. It's up about 0.25%. We're seeing a pretty flat performance for the S&P 500. Okay, let's get over to a keen student of history, Martin Cobb, Senior Vice President at Lorne Steinberg Wealth Management. Martin, thanks very much indeed for joining us today.
Good morning, Andrew.
There was talk yesterday, people said, well, look back to the 1973 Arab oil embargo. That was murder for the stock market. It caused inflation to rise. Is there any comparison between now and then?
That's a good comparison, and the answer would be no. The energy dependency of the Western economies back in the 1970s was much, much greater in terms of what it is today. And particularly with the US, the US is much more self-sufficient, not totally self-sufficient, but much more self-sufficient in terms of oil production, being the largest producer today. So I wouldn't draw many parallels between what happened in the 1970s twice and what is happening today.
And of course, back then, the Arab nations or the big oil producers united to restrict oil supply, but they don't seem inclined to do anything like that on political grounds anymore.
Yeah, I mean, it's hard for them to do because there is a surplus of oil today, but we're not in a tight oil market. Maybe getting tighter over the next few weeks. Time will tell how this whole Middle East conflict kind of pans out. But they really don't have the power that they used to have, given the, I guess, increased efficiency of the US on its own, and also just that there's plenty of production in other parts of the world. Brazil, parts of Africa as well now contributing. So we're not in the 1970s. We're not going back there, but there may well still be a period of sustained higher oil prices.
Let's have a look at Canadian Natural Resources. Maybe you could put up a 10 or 20-year chart. I mean, that stock, we almost need to start using logarithmic charts for some of these companies because this one just going vertical. Record highs today.
Yeah, I'm a mathematician, so I love my logarithmic charts, much more representative than a linear chart. We own Canadian Natural Resources, and we've liked it for a number of reasons. It's capital discipline, first and foremost. It's a low-cost producer. Again, we like that in the tough times. And here we are, results today, looking back the last 3 months of 2025. I mean, the oil price back then, we don't really care about that anymore, do we? It's ancient history. But obviously, they're well-positioned, good production growth. We like what they do in terms of their capital discipline. They will be a major beneficiary of higher oil prices. But even at oil prices in the 60s and 70s, they can generate huge cash flows. And we like the stock for the long term.
Let's switch back to technology. Broadcom, what's your view there? Because there have been worries over some parts of their business, including software. It's so important to them, but their device sales doing just fine, it seems.
Yeah, they're increasingly a hardware company. They used to be much more software. They bought VMware, they owned Symantec, but those businesses are almost at the margin now. The problem I have with Broadcom is, and it's maybe my Templeton days, I kind of, not mean reversion, but I like to understand what a business should earn, through a cycle. And we're definitely in a cycle, although some people suggest there's no such thing as a semiconductor cycle anymore. They're extremely well positioned, and they're making bucket loads of money. But 5 years ago, they made $8 billion of operating profit. This year, they're anticipated to make $88 billion of operating profit. So a lot has changed over the last half decade. And my concern is with their customers. The spend, which we all know is very heightened today, coming from the likes of the hyperscalers, the likes of OpenAI. I just worry that it's just a little bit too much. It's just too positive. And just even a slowdown in that growth rate will lead to pressures on revenues and a drop in margins for the likes of in Broadcom, for the likes of NVIDIA. The risk reward, to me, is just not that attractive.
You like the look of Visa. Now, I know that you're a big reader. I imagine you did at least have a look at that Citrini research piece on Substack warning. It was really a dystopian science fiction article speculating on what might happen when white-collar jobs are slashed across the economy because of AI. They touched on Visa and they said that it could be bypassed by these AI agents simply sending money to each other instead of going through gatekeepers like Visa. But you do think this company has a moat, as they say.
Well, I'll take you back, Andy, to PayPal. Coming along, it was going to undermine Visa or MasterCard, and ultimately it sat on the rails. I mean, Visa is a very, very fancy telecoms network. It's not a financial. They have no credit risk. They have really no relationship, some relationship, but very little relationship with the customer or the merchant. They provide the ability to process a transaction, authorize a transaction in milliseconds, and they can do something like 60,000 transactions a second on their global network. There are always competitors, Stripe and Plaid or others that are basically coming at this market, but they're a very, very, efficient telecoms network. No one is building that. And so unless you can get onto the rails and do something very, very different, it's hard to see how they will be ultimately undermined. We've had these arguments before, as I say, with the likes of PayPal, better, more efficient way of settling, transactions, certainly, but ultimately it's got to be communicated somehow, and Visa and MasterCard are the way to communicate it.
And then, of course, we know that the widespread fraud in cryptocurrencies and the lack of trust in anything you see on the internet right now, people may feel more comfortable with dealing with boring old Visa for the foreseeable
That's a really good
future.
point. I mean, yeah, we don't really talk about crypto, but it is just manna from heaven for the money launderers, or the criminal organizations. And whilst you can debate the merits of cryptocurrencies or blockchain, which I think is a really interesting technology, distributed ledgers, etc. The fact is that trust in financial transactions, remains paramount. I do think the whole blockchain technology ability to undermine the custodian bank or the intermediary, I think has some really interesting uses. But ultimately, when I'm sending money, I want to make sure it gets there and is not interfered with on the way.
And just give us your thoughts on Canadian Apartment REIT before we let you go, Martin. This is a stock or a REIT you like the look of?
It's a bit contrarian, isn't it? I mean, you were talking earlier about home prices in Canada. This too shall pass. At the moment, no one wants to buy a condo, so construction starts within the cities of Toronto, Vancouver, etc. are collapsing. So today the market is heavily oversupplied. Will be for the next year or two, but because of no construction, what we will be in 3, 4, or 5 years' time, I suspect we'll be in the opposite conditions, where apartments might be quite rare. And in that case, Canadian Apartment REIT is very well positioned to benefit from that. They will see some pain, but ultimately trading today on 0.7 times book value, maybe a 25% discount to NAV, long-term growth in apartments and rents, they're very well positioned to take advantage of that.
Thank you very much, Martin. Always great talking to you, and thanks very much indeed.
You too, Andrew. Thank you.
Okay, after this, we're going to talk about natural gas, in particular Tourmaline oil. That stock is actually down 2% in the past year, but we are going to hear that there are arguments for buying the shares. Let's focus now on Tourmaline. It has been a darling for investors seeking natural gas exposure, but that stock has languished over the past year. And even this week, it's down, despite the threat to global natural gas supplies, vast amounts coming through the Strait of Hormuz. There is Tourmaline. You can see, our chart there is showing it's up 1%, but my Bloomberg screens, it hasn't done anything. Let's face it, okay, given the surge in oil prices, down about 5% today. I was talking about since last Friday. Okay, so let's talk now to a manager who spends a lot of time crunching numbers from Tourmaline. Ernest Wong joins us, head of research at Baskin Wealth Management. Ernest, thanks very much indeed for joining us.
Happy to be here.
Is Tourmaline a stock to buy, do you think?
Well, we certainly own it, and we continue to be buying today. I think the big picture for Tourmaline, geopolitical issues aside, is that they are the largest natural gas player in Canada, one of the largest in North America. And they are very well positioned for a higher natural gas pricing environment because of things like LNG, data centers, and especially as U.S. natural gas basins start to mature and look to Canada for additional supply.
We should remember that even if global natural gas prices are in turmoil, Tourmaline has some international exposure, but they're still tied very much to the North American market.
That's right. So I think because of what is happening in Iran and the Strait of Hormuz, certainly LNG benchmarks have been rising, but not really contributing to higher natural gas pricing in North America, because most of the LNG export capacity in North America is already full and fully contracted. So there's not really a way for anybody, including Tourmaline, to be able to replace that 20% of natural gas that has been displaced. Now, I think to your point, Tourmaline does have some contracts that are tied to global LNG benchmarks. I think it's going to be about 8% of their production for 26 and 27. So it's a nice boost to their bottom line, but not hugely material overall.
I mean, I wonder when will they ever change the name? Take oil out of it when they're a natural gas company. But anyway, that's the way they like to do it.
Right.
So Tourmaline oil, is this one that you would just hold irrespective of your view on natural gas prices in that they are big returners of capital, et cetera?
Right. So this is really a capital allocation thesis more so than a bet on a specific commodity. I think the reason the stock is down today is because the natural gas pricing environment is fairly weak. They have said that there's not going to be a special dividend for Q1. Now, I think that is kind of the point of a special dividend, which is that Tourmaline uses special dividends so that in prices when natural gas pricing is high, such as in 2022, they can return additional capital to shareholders without committing to it in the future. And I think as shareholders of Tourmaline, we're really pleased that they're deciding to retain capital, to really focus on completing their infrastructure build out to position the business for the next decades beyond.
Just sorry, you touched on this, Ernest, but just remind us, what is their LNG exposure? I mean, ultimately, how much of their production could start going to LNG exports, or do you have any kind of number on that?
So for 2026, about 8% of their production is tied to LNG benchmarks. They are not a direct participant in LNG Canada, but they are a participant in Rockies LNG, which is still deciding whether they want to go forward with that project. But I think the bigger picture for LNG is that as 11% of natural gas goes in the Canadian energy basin goes to LNG, that is going to be a tide that lifts all boats, including local AECO benchmark pricing. And we have yet to see that, but I think at least still moderately bullish on that in the medium term.
And of course, Qatar has really got a black eye, hasn't it, in this latest violence in the Middle East? It has been hit by Iranian attacks, and in the past it said, well, we're a rock of stability.
Sorry, can you repeat that?
Oh, just talking about Qatar in the Middle East, the huge LNG exporter.
Qatar, yes.
Yeah, sorry.
Yeah, so Qatar is the largest exporter of LNG. They're responsible for about 20% of global LNG exports. They have curtailed that because of the issues in the Strait of Hormuz, mostly exporting to Asia, places like China. And again, there's no real way for the world to be able to find alternative sources of LNG to replace that. And that's why you're seeing spot LNG prices rise quite significantly over the last few weeks. Now, I think what you will see is that in places like Asia or even in North America, because of higher LNG prices and the lack of supply, they may end up switching back to coal. So that is something we've seen coal prices rise by 20% over the last week as well. And so I think there's a lot of dynamics in terms of how that ends up influencing natural gas pricing in the near term.
Thank you very much indeed for joining us. Always great hearing from you, Ernest. Ernest Wong is Head of Research at Baskin Wealth Management. Coming up, we're going to take a look at 3 Canadian ETFs that offer a chance to diversify your portfolio. The ETF report is up next. Let's get to the ETF report. Our guest has 3 ideas in Canadian ETFs that may be an idea if you're seeking diversification in your portfolio. We're joined by Cole Kacher, Senior Investment Advisor and Portfolio Manager at Wellington Altus Private Wealth. Cole, thanks very much indeed for joining us. And of course, ETFs, so many, perhaps too many, thousands out there, but they offer such a variety of tools.
Yeah, they can be a great, a great access to different markets and, a tool in the toolbox. But like you said, when ETFs were first introduced, they were a little bit more basic. They were just basically passive investments following certain indexes. And over the years here, as, multiple new players have gone into the sector, they've almost essentially become like mutual funds in a lot of ways. So I think you have to educate yourself or, be careful exactly what you're getting into because there's a lot of different nuances to them. And, sometimes what you think you're getting isn't exactly what you're getting, whether from an investment or from a fee perspective.
It's interesting. S&P Global is out with some analysis today, and they say over every time horizon from 1 to 10 years, more than 90% of Canadian equity funds underperform the S&P TSX composite. So it was probably a good idea, those ETF index funds.
Yeah, I mean, it's. I think the most famous example was after the market crash in 2009, where Warren Buffett made some bets against, I think, hedge funds and active managers, and the S&P handily outperformed everyone, I believe. So it's really just stock picking is hard, and volatility is paramount. And in an ETF-driven world, the moves are fairly significant, and it's just hard to build a portfolio of individual stocks. And I think a lot of people have wisened up that ETFs can get you where you need to go.
So you have an idea here. XSP, it's an iShares Core S&P 500 index fund. It's hedged to Canadian dollars, but this one, of course, you are going to be getting that big weighting in the Mag 7 stocks.
For sure, yeah. I've kind of, when we were talking about some ideas, I thought a barbell approach would make sense right now, just because there's a little bit of uncertainty in the market and there doesn't really seem to be a clear direction. So the XSP is kind of a core holding that, you get exposure to a market-weighted S&P 500 index. The cost is basically zero. I mean, it's very insignificant. And you get exposure to essentially, the market-weighted 500 biggest companies in the U.S. So it has underperformed equal weighted a little bit just because, some of the heavy hitters haven't, done as much for sure this year. But I think over time, if you own the market-weighted XSP or S&P 500 index, you're participating in some of the bigger moves of the biggest companies.
Then you have an idea for us. It's a tech play. It's the CI Tech Giants Covered Call ETF. And the idea here, of course, is to give you these big U.S. tech giants, but also a yield, certainly a yield on paper.
Yeah, exactly. So, covered call strategies have really come into, the ETF world over the last number of years. And, there's varying strategies that can be used, but the underlying idea is that you're going to generate income and, in response of getting that income, you're kind of giving up some of the top line growth that can potentially happen. So you're getting exposure again to a more tech heavy basket. But because of the volatility of those sectors, the call options on them can generate more income. And that's where you see a fairly substantial distribution that can come from this. So again, it's going to move around like the tech sectors. So it's not like you're immune to volatility. It's just that you're getting paid to wait. If, the market goes down 10%, you're clipping some coupons where specifically if you're on a fixed income or need cash flow, then you can just clip the coupon and use that. And hopefully, the market will recalibrate itself.
I got to admit, though, I'm skeptical on a lot of these covered calls. I'm just looking at my Bloomberg screen here, comparing the TSX, this particular ETF, with the Bloomberg Magnificent 7 Total Return Index. And I'm showing that since 2023, when I think TXF was launched, it has a total return of about 90%. Less than half of the return, and this is both in Canadian dollars, from the Mag 7. So you give up a lot of upside with these darn things.
You can, yeah, and that's where I think it's important that it's not a one ticket solution. I think it's part of a diversified portfolio, and to people who can stomach just the moves of the market, they might not be the best option, but there's a lot of people out there who don't do really very well at stomaching the moves of the market, and having some type of cash flow or return generation can really help keep them in the market. So certainly if you're wanting a pure play on, just the pure returns of a given, sector or stock sector, then the covered calls aren't going to be the way to do it. But that's where, adding diversification or adding, multiple kind of approaches, because at any given time, some are going to work better than others.
And then finally, another idea, the Hamilton Utilities Maximizer ETF, UMAX. And again, it uses covered calls to give you, on paper anyway, a big yield.
Yeah, and so again, that's kind of the barbell strategy. And, this is just 3 ideas, but within, I think, a proper portfolio, you're going to have more than 3 holdings. You're probably going to have, 5 or 6 ETFs is the more likely kind of structure you should be using. So this, again, so on one side, you're getting, the tech barbell that, will generate some cash flow. In the middle, you're getting the S&P 500 exposure. And then on the other side, you're getting, a little bit more of a utility component that is more interest rate sensitive. So you're kind of getting exposure to, 3 different channels. And again, you might just look at it and say, hey, I like the utilities. I don't want the covered call. I just want to own the utility basket. And if that's the case, that's fine. In this scenario, I know a lot of people, just from my call-in shows on BNN Market Call, that a lot of people are really interested in the Hamilton ETFs and specifically in, the high cash flow. And so, I think Hamilton's done a good job, and whether it's the UMAX or other ones similar.
Did we lose Cole there? Oh, okay, sorry, we lost Cole there. Thank you very much, Cole Kacher, for that. I got to admit, though, it looks pretty similar to me that if you buy that Hamilton one, you have a total 5 year, or so not 5 years, since 2023. My screen is showing a total return of 26%. Whereas if you simply bought XUT, which is the iShares Cap Utilities Index ETF, you would have had a return of 40%. So these covered call ETFs, I wonder about them, but of course nobody's asking my opinion. You do pay, though, for that supposed big yield. Coming up, we're going to show you in charts just how much of a rupture Trump's tariffs have created between our 2 countries. Shares in Canadian natural resources hitting record highs today. The country's biggest oil and gas producer posted revenue that topped estimates in its latest quarter, as well as better than expected profit. There was record output, and that offset weaker oil prices. In fact, production was up nearly 13%, and the company raised its forecast for output this year. The dividend is also going up. Spin Master, the toy seller, posted profit and revenue in its latest quarter that topped expectations, and there was an increase in sales in the digital games segment as well as the entertainment segment. However, the stock today has hit its lowest in at least a year. Spin Master said it expects revenue this year to be flat or in the low single digits compared to 2025. Shares in Broadcom are up after the chipmaker posted better than expected first quarter results. Profit and revenue topped expectations, and the company provided a revenue outlook in artificial intelligence that was well above consensus. It now sees AI chip sales topping $100 billion US in 2027, and it's buying back $10 billion worth of shares. And there's a look at the North American markets slipping a bit today, partly because of fears of a global energy crunch. We have seen North American oil moving towards $80 US. U.S. President Donald Trump's tariffs on Canada and Mexico came into effect on March 4th of last year. It was an early volley in an escalating U.S. trade war between America and the rest of the world. Let's get a glimpse, though, of what it has meant so far for Canada. We are joined by Bloomberg's Najoud Al-Maliz, who has some illustrations here of the big changes that we've seen. Thanks very much indeed for joining us.
Thanks for having me.
You have some really good charts here, so if it's okay, I'll just jump in and show them to the viewers. So if we look at Canada weaning itself off the addiction to America in terms of goods imports and exports, we've certainly seen quite a decline.
Absolutely. We exports last year to the U.S. fell by 5.8%, but we also bought less from the U.S. And so you see the impact of the trade war, both in terms of what we're sending to the U.S. and what we're bringing over from the border. Mm-hmm. And conversely, that's been to the benefit of the rest of the world, that we've been exporting and importing more from other countries. Exports to countries outside of the U.S. were also really helped by the fact that gold prices skyrocketed last year. But even if you exclude gold, you see that exports to other countries has increased. And so you see how Canada's trading relationships have really shifted last year, with its closest relationship being fractured, but also some success in Canada's effort to look at other markets elsewhere.
Yeah, so the amount of goods exports going to America was about 75%, and it's gone down now to about 67% in the latest reading. Canada's growth has not been so great, but last year it was still the second best in the G7.
Yeah, so if you go back to a year ago and you had told people, well, the economy is going to grow by 1.7% this year, people would have said, well, that's not too bad, right? Back then, we were expecting an economic apocalypse when President Trump was threatening across-the-board tariffs, and we didn't really know whether he would actually follow through with that, if it was a negotiating tactic, would he repeal some of these tariffs? And so we landed at a different spot where it's really these sectoral tariffs that have caused damage on the Canadian economy. And so we haven't entered a recession, but that doesn't mean that there hasn't been real pain in the Canadian economy, again, particularly concentrated in steel, aluminum, autos, lumber. And so it's really an uneven year for the Canadian economy, but again, not the best, not the worst.
There is pressure, though, on our core industrial exports. Talk to us about that.
Yeah, absolutely. I mean, again, even looking at the sectors affected by these sectoral tariffs from the U.S., it's the impact is uneven. A lot of attention has been pointed towards the auto industry and steel, that they would have a harder time without some sort of tariff resolution with the U.S. And so we've all heard the headlines over the last year about the auto industry, the plant shutdowns, the jobs lost, both at auto manufacturing plants, but also in parts manufacturing. And that industry is holding its breath for the USMCA renegotiation, or sorry, not renegotiation, we shouldn't be saying that, review in the summer, to see what exactly will its future be. And the steel industry is also going through a tough time where again, a lot of their business has been intertwined with the U.S., and they have relied on this ability to sell to the U.S. And now the conversation is about retooling their plants and their factories. But that's not an easy thing to do. And so we'll see how much Ottawa is successful in helping that industry transition if it needs to.
And Canada was the biggest buyer of U.S. goods, but has now been supplanted by Mexico.
Yeah, I mean, again, showing how Canada's trading relationship with the U.S. is being reconfigured in multiple ways, not just in terms of what we're sending over there, but what we're buying from the U.S. And really, I mean, the impact of the trade war has been quite broader than just even the economic metrics. You think about how Canadians have shifted their own behavior in response to the trade war. Travel, return trips to the U.S. last year were down 25%. We know that Canadians have made an effort to avoid American products. You have U.S. liquor off of the shelves in Canada. And so our entire economic and political relationship with the U.S. has shifted a lot over the last year. And the question now is, how permanent is this change? And only time will tell on that front, I guess.
I have happy memories of traveling holidays to the States. One time I was in Fresno, California with my dad, and we asked at a gas station, hey, do you know where this motel is? And the guy said, you know, that'd be a good motel to go to if you're looking for a date. So we didn't go there. Anyway, sorry to strike that particular note, but we had such great trips to America. Anyway, we know this, but it is striking, the fall off in Canadians traveling to the U.S.
Yeah, absolutely. Again, I think the trade war is more than just about tensions between Ottawa and Washington. Many Canadians have, I don't want to say turned on the U.S., but they feel betrayed by our southern neighbor, because there is such a tight relationship between these two countries, not just in trade, but in terms of the movement of people, and that the U.S. is a frequent destination for travel for us here in Canada. And the fact that Canadians have chosen to withhold their travel at a time when they were traveling overseas at higher rates. It's not that Canadians were cutting back on vacations in general. They just made an active decision to avoid the country that's the easiest to travel to. And again, going back to the point of choosing to boycott U.S. products. I mean, I've seen it. I'm sure you've seen it at grocery stores. People, looking at the tags, trying to judge where this is from, choosing to pay maybe a little bit more for another product. And so it's even affected our security relationship. A lot of Canadians see the U.S. as a security threat now, the greatest security threat to Canada. And so it's really a fractured relationship on multiple fronts 1 year out.
Yeah, so another of your charts do indicate that Canadians rank the U.S. as a leading security risk. Wow, worse than China or Russia. I mean, whoa, what have we come to? Canada recording its highest weapons spending in 2025, going back at least to 1961, and it sounds like we're just getting started.
Yeah, it's interesting. There's two ways to think about Canada's increased military spending. On one hand, there's been pressure from the United States for Canada to increase its defense spending and meet these more ambitious NATO targets. But on the other hand, I think Canadians, looking at the fractured relationship with the United States and the U.S.'s own, threats of annexation, whether Canada or Greenland or its involvements elsewhere, many Canadians now see the value in spending more on the Canadian military. And so there are these pressures from both ends of the issue, really. And the result is that Prime Minister Mark Carney has more of a mandate to be spending that kind of money on the military, whereas I think a few years ago it would have been unthinkable to think that to imagine the government being able to justify to Canadians spending billions and billions of dollars on defense, something that really has not been a priority for many, many years in this country. Thanks a million. Some great stuff there. Really appreciate it. Thank you. Bloomberg's Najut Al-Mallis with some fantastic charts there. Okay, we've got hot picks coming up, and we are going to zero in on the airline sector. You are watching The Open. Hot picks, let's zero in on three airlines. Our guest does like the look of United. He says consumer demand, despite obviously disruption in travel to the Mideast and from that region, consumer demand looks strong. And the management team at United has credible long-term financial targets. We're joined by Tom Fitzgerald, analyst at TD Cowen. Thanks very much indeed for coming on the show.
Thanks for having me.
Start off with United, if you would. What's distinctive about this carrier?
We view them as having the most attractive earnings upside due to the combination of idiosyncratic tailwinds from the various initiatives management's pursuing, as well as the really attractive industry fundamentals that have been ongoing the last handful of years.
That's interesting. What has been good for the industry in the past 10 years? Just people crazy to travel, tourism boom?
Yeah, I mean, travel demand has been very resilient. International travel demand, where United is the leader among the big U.S. airlines, that has seen really strong growth coming out of COVID. There was some debate back in 2022, 2023 about whether this was just a short-term sugar high and pent-up demand from the pandemic, and that would normalize back out. But instead, we've seen a secular leg up in really strong, robust U.S. outbound travel demand.
And what are they doing in technology that's distinctive?
That's a great question, Andy. They've had a lot of really interesting investments on their mobile app, in improving, customer communications, customer overall experience. They're installing Starlink across their whole fleet, which should be completed by the end of next year. That starts to enable interesting opportunities on the advertising angle over the long term. And then, just kind of run of the mill on the cost side, whether it's on the management team and closing the books on their accounting faster than normal using AI, or using technology and things like predictive maintenance, or recovering from irregular operations. They tend to be very forward thinking on the tech side.
I'm just looking at the stock over 5 years. It has been something of a star. We got a 1-year chart there, but over 5 years, I'm showing the shares up more than 80%.
They've had a nice run lately as the market started to appreciate the earnings upside for the business, as they've been implementing a lot of their long-term targets since the latter part of the 2010s, and now they're starting to approach harvest mode for all their work. So it's a really exciting time for the company, and investors are excited as these good things come in, and they reap what they've been sowing. That should lead to a lot higher free cash flow conversion down the line.
Okay, our chart there is showing a number close to 64%. My Bloomberg screen is showing closer to 80%. And Delta. Delta, you like the look of this one. It hasn't been such a great performer as United over 5 years, but what has this company got going for it?
They remain the leader in premium, in corporate travel, and in profitability across the U.S. airlines. They continue to enhance their revenue diversity, which we saw was a major contributor to their resilience last year. It likely will continue to be a major contributor to their resilience in the years ahead. And this is in things like growing loyalty to the long-term targets, building that into almost a $10 billion business, building up their maintenance, their third-party MRO capabilities into a multi-billion-dollar business over the years ahead, and lowering the main cabin share of revenue down to 40% from 15 years ago. It was 60%, and that really helps to de-amplify the volatility of the business.
That's interesting. So the main cabin, I guess that's the people who are paying economy flights. Traditionally, it was 60%, I think you said, of total revenue, down to 40%?
That's their long-term goal, yeah.
Oh, okay.
Yeah, but that substantially, that really lowers the volatility of the business. I mean, those are the most price-sensitive customers. That's where there's more competition from low-cost carriers. So those type of things, it helps to build more durability into the model.
I'm lucky. I have a long torso and short legs, so I don't mind sitting in steerage on aircraft. But
that's great. It gives you a lot of optionality.
Yeah,
I'm the opposite. I'm pretty lanky, so I tend to always hit the bid on buying an extra legroom seat.
Yeah, my wife too. She's not having any of those seats crushed together. Finally, Alaska Air. This stock has struggled a bit over the past 5 years, but you see promise here.
I do, and I think there's been a lot of things clouding over some exciting developments there. The macro, which has affected the whole industry, and then Alaska being a predominantly a West Coast airline, they have more exposure to West Coast fuel benchmarks, which tend to be a little more volatile than the industry, and over the last 2 years have been much more volatile. But we think if you look through the noise over the long term, as they reap the benefits from integrating Hawaiian Airlines, which they acquired in late 2024, this is a 1 + 1 = 3 type of merger. It enables a lot of network optimization, turning Seattle into a long-haul global hub. And
no, did we lose Tom there?
Sorry about that. I think I hit the mute button. Reshuffling the deck to turn Portland into a connecting hub, take more share in San Diego, optimize their Hawaiian franchise. leaning into premium and loyalty. And if you think about probably about 70% of their routes are on 1,500 miles or longer. And those routes historically show a much higher propensity for consumers to pay up for the premium products. So it dovetails really nicely with the overall secular backdrop right now.
Again, that's that old circulation thing. If you're on a long route, you don't want to be crammed in. Thanks. Just, Tom, we're almost out of time. Just tell us, you spend a lot of time looking at the aviation industry. Is there something that strikes you as interesting that the public just doesn't realize about this industry?
I think the gentrification from an investor standpoint is really, in the U.S. specifically, is really important to keep in mind. And historically, there were just always way too many competitors, not chasing too few seats. Now you're moving to a period where you're probably going to have 6 major airlines competing in the big markets, and with the discount carriers focusing on underserved, less attractive markets for the majors, which I think should de-amplify the volatility in their profitability, in their revenues, and give investors more conviction in underwriting investments in the space.
Thank you very much, Tom. I really appreciate it. Tom Fitzgerald, analyst at TD Cowen. Coming up, we'll do one last check on the markets. Stocks under pressure today. Let's check out the markets before we go. We'll start off with North America's benchmarks. We did see oil prices once again cresting higher, but stocks in Toronto under pressure today. American stocks also down because there are fears that these Israeli and U.S. attacks and the Iranian retaliation against Gulf nations and U.S. bases in the region will continue. Last price I saw for oil, though, was almost $79 U.S., up from less than $75 yesterday. So oil prices rising once again, and that does point to inflation in theory. Let's have a look at a one-week chart for the TSX. TSX, of course, hit a record high on Monday and hasn't got back there since. And let's have a look at the materials, because we have seen some pressure on copper. There's been a huge flow into warehouses tracked by the London Metal Exchange, and copper prices as of yesterday were down almost 3% in the past 5 days, because of course this is going to be disruptive to global growth if the massive increase in energy costs stick. Citi argues that copper could bounce back very rapidly to the range of 13,500 to 14,000 US a metric ton within weeks if the Iran conflict peters out. Of course, copper did get to record highs earlier this year in January of around 14,500, but we are seeing weakness in copper stocks today. In mining, there's an awful story out of the Democratic Republic of Congo about a rebel-held tantalum mine. Saw a major slide and 200 people dead, including 70 children. That's near the eastern Congolese town of Rubaya, and that happened earlier this week. Let's maybe have a quick look at the oil price right now, because oil has been having posting quite a recovery this year. Look at that, oil spiking up to nearly $79 in trading right now, and oil was up. It's now up in North America year to date about 37% from, of course, the slump that it posted in 2025. Thanks very much indeed for watching. We've got morning markets next.